Ladies and gentlemen, dear members of LuxCMA, dear future members of LuxCMA, I have the pleasure to welcome you to our second Capital Markets Day. I'm happy that we had so many registrations, but I'm a little bit ashamed that not all are here yet. We had 250 registrations, and I guess some will come later. My name is 𝗟𝘂𝘅𝗲𝗁. I'm the member of the executive board, and I will guide you through this evening. I'm not only the treasurer of LuxCMA, but I will also be the timekeeper and make sure that we do not have that much delay. That's why I will also skip the presentation of the agenda, because that saves already a little bit of time. The evening will be mainly treated by our working groups. And the working groups are of LuxCMA, there are 8, and they are really active. You can see this in the publications we have, you can see this in the active and open discussions during the meetings. And tonight, you get the best of our working groups. So we have a working group on tax, sustainable finance, and on digitalization. They will all speak. Taking this moment, I would like to thank you all the members of the working groups for their active participation, for their commitment, for their motivation, and for their fruitful impact. Without you, LuxCMA wouldn't be there. That's why, conscious of time, we will directly hand over to Julie Becker, the chair of LuxCMA and the Chief Executive Officer of Luxembourg Stock Exchange. I know you all know her, so I will not present her in detail. Julie, the floor is yours.
Ladies and gentlemen, dear members of the Luxembourg Capital Market Association, it's a real pleasure to welcome you tonight for the second edition, indeed, of the Luxembourg Capital Markets Day, 4 years exactly after we created our small association. I promise I won't keep you long neither, as we indeed have a full agenda tonight, filled with engaging speakers and very interesting topics, and of course the networking reception that I'm sure you are all looking forward to. I'd like to start as well by underlining how happy I am to see, even if a bit less than expected, but many familiar faces, however, that are gathered today. And when I look in this room, what I see is the image of the Luxembourg Financial Center and the capital markets industry in particular, which means that I see competence, experience, and diversity. It's your work, our work, that has earned us a place amongst the top financial centers, not only in Europe, but also worldwide. And now, today, is, of course, an opportunity to celebrate our achievements, our successes, and see how far we've come since we have been created. But let's be honest, the past 3 years have not been very easy. We've had to face a global pandemic, record levels of inflation and rising interest rates, not to mention significant supply chain issues, market volatility, and last but not least, a war on borders of Europe. Despite all of this, Luxembourg capital market activity remains very active and so far competitive. We are the destination of choice for multiple market participants from across sectors and geographies. But today I'd like to focus our conversation on the future and how we can ensure Luxembourg's long-term competitiveness in the years and decades to come. Because competition is growing in Europe and at a global level. And of course, as capital markets professionals, we should embrace this competition. And this means strengthening Luxembourg's own capital markets industry and making sure that we remain a progressive and attractive jurisdiction. But our industry is undergoing a significant transformation driven by a shift in global priorities. And if we are to stand up ahead of our competitors, we have to be agile, innovative, and bold, and seize the opportunities that present themselves as and when they do. As underlined by the EU's ambitious green and digital agenda, it's no secret that today the two overarching priorities are digitalization and sustainability, two words that go hand in hand. Our economies are rapidly going digital, and we should be eager to explore the full potential of groundbreaking technologies such as AI and DLT and capitalize on these developments to make our industry and Luxembourg as a whole an appealing place for business. But the fact is that we cannot prioritize digitalization without financing the transition away from high-emitting activities in the first place. And while we have to recognize that there has been some progress, and we have noticed an important shift from conventional to sustainable financial instruments in recent years, and I'm sure Pierre Gramegna, as former Minister of Finance of Luxembourg, remembers that at the very beginning of the first green bond being issued, we were speaking about less than 1% of cumulative sustainable debt issuances worldwide. We've just reached $4 trillion mark last month of cumulative sustainable debt issuance worldwide. But we are in 2023, halfway from 2030, and we still need to mobilize huge amounts of capital. And as capital market professionals, we have a responsibility to help mobilize financing for the transition. Our contributions and our efforts, which are numerous, as Holger just underlined, will ultimately determine whether or not we will succeed. Remember, to decarbonize the world, we need to decarbonize capital markets. Before I conclude, I would like also to stress the crucial importance of unity. Building a strong sense of belonging and collaboration in Luxembourg is the key of being truly competitive in Europe and beyond. But it is just as important for us to be united on a European level, which is precisely what the Capital Markets Union plan strives to achieve. Not only will this harmonization help facilitate cross-border investment opportunities, streamline procedures, enhance transparency, but it will help to build up the confidence and the competitiveness of European markets on the global stage. And it will contribute to growth and prosperity in Europe. I'm very pleased to share with you that very shortly you will hear more about why it is essential to deliver on Capital Market Union from Pierre Gramegna and get his unique insights into what steps are needed to reach this goal. One thing is certain, it's only by harnessing our collective strengths and embracing diversity that we will be able to navigate challenges and to seize the opportunities in Luxembourg's and Europe's capital markets with the hope of making a true and lasting impact well beyond our horizons. Thank you very much.
I now have the honor, the great honor to welcome Pierre Gramegna. I know everybody in the room knows him very well and his achievements while being Finance Minister of Luxembourg from 2013 to 2022. During this time, he was also a member of the ESM Board of Governors, and today, Pierre Gramegna is the Managing Director of the ESM and also the CEO of the European Financial Stability Facility, also since 2022. I'm not sure if we have the time to go all through the positions you had during your career, but I will only list a few. In his capacity as Finance Minister, Mr. Gramegna served as Governor to the International Monetary Fund and several multilateral development banks. Here we have also the link to our tax panel. In 2017, he set up the Luxembourg House of Financial Technology to promote fintech and enhance digitalization of the financial center. Here we have the link to our digitalization panel. And Mr. Gramegna is also committed to issues related to climate change, illustrated by his participation in the UN Climate Change Conference in Kyoto as the spokesperson for the EU, and afterwards as finance minister in Bonn and in Madrid. And he has taken initiatives in the field of sustainable finance, including setting up climate finance platform with the European Investment Bank. And here we have the link to our sustainable finance panel. Mr. Gramegna, thank you for enriching this event, and welcome on stage. Thank you.
Ladies and gentlemen, it's a great pleasure and honor to be here with you. Thank you for inviting me, Julie and Holger. It's truly a pleasure to address you in this room, which is a symbol of Europe, because this hemicycle was built to host the European Parliament back in the 80s. You might wonder why I was invited to speak on the topic that we chose together, why a capital markets union ? And I thought I should start by telling you what the ESM does, because probably you all have heard about it and you take it for, or some people take it for granted, and maybe it's good to just say that the ESM was created in 2012 to complete the architecture of the European finance. And it happened at the time of, or in the aftermath of the financial crisis. So since its inception and the predecessor EFSF, we have issued roughly 300 billion euro of bonds. We are refinancing these bonds on a regular basis. This year we're going to refinance roughly 30 billion of euro, mostly euro. So we are very much present in the markets. So we have a good view on what markets are about, what they can deliver, what they cannot deliver, their strengths and their weaknesses. But then at the same time, as the managing director of the ESM, I sit in the Eurogroup as an observer in the first row around the table, and I intervene there, as I used to do as a finance minister for 8 years. And as was rightly pointed out, I was a governor of the ESM. And as such, I knew the institution, and I continue, obviously, to contribute to the discussions that are happening in the Eurogroup on a regular basis every month when we meet. So I have followed the topic of the Capital Markets Union since the discussion started back in 2014, and I continue to follow them today. In all the previous jobs that I've done, I have always been convinced of a very simple thing. And not only because I'm a Luxembourger, and not because Luxembourg is a huge financial center, but because I think it is common sense. Finance is the bloodline of our economies. I would also like to maybe add the sentence, we will only have a green and digital economy if finance becomes green and digital itself. The topic that I'm supposed to cover is, why do we need a capital markets union? I think here in the room probably many of you are already convinced, but let me try to say in a nutshell what a better integrated financial market in Europe would ensure and bring about. Things that we already have, but not to the right extent. Because what you need in a well-functioning financial market or financial markets, if I speak of the 27 countries of European Union or the 20 countries of the Euro area, is you need diversity of finance in order to cater to the needs of the economic actors. You need competition between the different actors so that services are delivered in an efficient way. And third, you need size. I think that the Capital Markets Union probably reminds us of what we have achieved with the EU single market back in 1993. It was about delivering the free movement of people, goods, services, and capital. That was 30 years ago. And probably many thought in 93, having achieved the free movement of capital, we have done our job. 30 years later now, we realize, because of many reasons, different crises and even COVID, that it's not enough to have free movement. You need to have similar regulation, a similar framework, and that's what the CMU is all about. It was launched, the whole discussion, in 2014 by the Juncker Commission. I remember it very well. It had an ambitious plan. It was supposed to finish its job by 2019, and here we are, and only part of it has been delivered. Now, it is important to see that when you speak about a strong financial markets or an integrated financial market in European Union, you have also actors in that market, and the main actor, obviously, in Europe is banks. So we need strong banks, and we need a strong integrated market. Now, on banks, we've done much better. My first Eurogroup in December 2013 was when there was agreement on the banking union. And at that time, many observers thought that we had a political agreement, but that we could not deliver on it. They were proven wrong. Most of the essential pillars have been delivered. I know there's still EDIS, India, there's still a few things that have not been achieved, but quite a lot has been achieved in that area. And needless to say that we have seen that the banking union has brought about what we really needed, that is resilience. Stronger banks, better capitalized, better liquidity. And this better regulation, this strength that our banks now demonstrate, has been shown in the latest financial crisis that hit the United States and Switzerland. If in the financial crisis of 2008-2009, banks were the weak link, the weak spot here in Europe, now you could say that they are the strong link in financial matters. So it shows that by acting in the banking union, we have done the right thing. Besides a deeper, more integrated financial market, and I'll come back in the second part of my presentation, what's key for that, let's also not forget that we have challenges in front of us that are enormous. Now, the digital transition and sustainable finance or green economy is the obvious one. You know, it's also the one that is the absolute priority in the NGEU program of the Commission. But many things that we are looking at are related to public finance. But public finance cannot do the trick alone. Public finance is only a part of the equation, and public finance must help to bring into the whole picture also private finance. This is all the more important in a period of war on our continent, and it's all the more true at a time of inflation. With the inflation that we have and the higher interest rates, we need to mobilize capital, and we can probably do that, certainly better do that if we have a capital markets union. Let's face it. Capital markets of Europe represent roughly 60% of the GDP of the euro area, 60%. In the United States, the ratio is 150, so 2.5 times as much. So that's what I said about size matters. And when you have a well-functioning and strong financial market framework, you also have risk reduction, because when banks have problems, the financial markets can compensate and vice versa. So now looking ahead, where do we stand? So recently, the president of the Eurogroup has agreed a statement how we should proceed in terms of timing with the Capital Markets Union. We had a first round of discussion in May about this topic, and unfortunately, I have to tell you, there was a consensus that all the low-hanging fruit of Capital Markets Union have been taken, have been used, and the things that still need to be done are more difficult issues that need to be solved. So we need a Capital Markets Union for 5 reasons. First, to deliver on the climate change agenda. There, Europe is rather well positioned for 2 reasons. The euro is the key currency that is used for green bonds. Roughly half of all the bonds issued are denominated in euro, whilst the dollar is around a quarter. And second, and that is interesting because it's connected with regulation, Europe is leading in what is called taxonomy. That means we have a framework in Europe that we have painfully put together, and I know that Julie Becker herself was involved in the working groups. And so here Europe is showing the way, and the Luxembourg Stock Exchange has innovated by creating, as you all know, the Luxembourg Green Exchange, being a leader in this field, also because they have recognized earlier than others that this area will develop a lot in the future. So yeah, here we have a combination of 2 things. One is the recognition of climate change as being a key issue, and second, giving ourselves a framework on which to decide what is really green finance, avoiding greenwashing compared to others. The second reason why we need stronger integrated financial markets is because we could inspire. How can we do that? Well, we could inspire ourselves of what we have done for the banking union. For the banking union, we decided to put in place a single rule book. And this single rule book has obviously been the framework to organize a common supervision. Now, the common supervision, which is called the SSM, Single Supervision Mechanism of the European Central Bank, is, to my mind, an interesting combination of what Europe can create as legal framework, because it is not a one-size-fits-all. It is a combination of supervision by the European Central Bank with the national supervisor in structures that are called joint supervisory teams. And we could also learn the lessons of that experience and apply the lessons learned to a common single rule book for capital markets, taking into account the necessary national specificities and prerogatives of the countries. The third element I see as key is securitization. We all know that since the crisis of 2007-2008, securitization is viewed with prudence. I remember that in the presidency of Luxembourg in 2015, we agreed on some elements of securitization, which was then implemented, but it was only a small step in the right direction. But I think that securitization can be the missing link between banks and capital markets, because they can help each other here, as is well put here in my note. It helps banks offload risk from their balance sheet responsibly while offering new investment opportunities. So banks and capital markets are complementary, and you cannot even imagine anyway markets functioning without banks. So securitization is extremely important, and to me it is something that resembles, in a way, green bonds. Because what you do with green bonds is that you have targeted financing. And in securitization, well, you have targeted guarantees. The things resemble each other. It's not the same. But you see that we are in a phase where finance wants to act with more precision and with more precision and more targeted objectives than was done in the past. And it's also what the consumer wants. Consumer now ask you, what are you going to do with that money? It's what the voter asks his government. People don't like to pay taxes, but if you tell them what's going to be done with taxes, they agree much more to paying taxes. The fourth reason why integrated financial markets is key is obviously for small and medium-sized enterprises. Their access to finance is very, very complicated and is very much dependent on national markets. And here we have a huge gap that needs to be filled. Fifth and last, having an integrated capital market at the EU level would benefit from additional European safe assets. So what do we call safe assets is obviously bonds that are issued by European institutions, and there are 3 who are issuing bonds as we speak. Historically, the first was the European Investment Bank, which was also the first issuer of green bonds. The second one was the ESM, and the third one is the EU Commission in the framework of the NGEU program. And what we have seen with these issuers, they use most of the time Luxembourg law, which is an innovation, due to a certain extent also that with Brexit reference to British law that was often used was not ideal anymore. And I think we can be very pleased as Luxembourgers and players here in Luxembourg, but it goes beyond obviously our country, that having these safe assets will help have a more integrated market in finance as we wish it. So in conclusion, I think that to get the size that I mentioned, that is far too little, too small compared to the United States, to get greener and to get more digital, the Capital Markets Union is key. And let's not be afraid of that adventure, because creating a new framework can bring great benefits. I think here of the precedent of the UCITS directive of 1989. Who would have thought that thanks to a regulation, and I would like also to do the parallel here with the taxonomy, but thanks to the UCITS directive, it was possible to develop the investment fund industry all over Europe and make our model the reference for the rest of the world. So I think Europe needs to act in this matter. It needs to act together. And I would like to finish with the motto that I like a lot. So if you want to walk fast, walk alone. If you want to walk far, walk together. Thank you.
Gramegna, thank you very much for your insights in the Capital Market Union, and also that we learned that securitization will play an important part of it. Yeah? I have now a topic which was one of the reasons why LuxCMA was established in 2019. Already then, we saw the impact of the Anti-Tax Avoidance Directive 1 and the impact of the Luxembourg securitization market. Now, we have not only ATAD 1, we have ATAD 2, and ATAD 3 is coming. And I'm really excited how the members of our tax working group Okay. Recent past, the present, and the likely future of direct taxation of Luxembourg securitization vehicles. The next panel is called Securitization Vehicles and Anti-Tax Avoidance Directives, Striking a Balance, and is driven by Anja Taferner, the leader of our tax working group and executive director of EY Luxembourg. The floor is yours.
Thank you, Holger. Had there been a Capital Markets Day 10 years ago, we would not have been speaking about tax and securitization, because securitization companies were by law designed to be tax neutral, and they were just that, they were tax neutral. But then in 2019, the Anti-Tax Avoidance Directive became effective, and all of a sudden we started talking about interest limitation rules and the question, can securitization companies deduct all their interest expenses or not? As Holger said, we want to do a little tour of the recent past of securitization and tax, look at the present, now that we have two anti-tax avoidance directives that are in force, 𝗟𝘃𝗲𝗏 and 𝗟𝘃𝗏, and take a little look at the future, what 𝗟𝘃𝗏𝗏 may or may not bring. To do this, I'm joined here today by three expert members of the working group. To my right, we have Sophie Richard, counsel at R&D Medernach. To her right, Luc Petit, tax partner at PwC, and to my far right, Geoffrey Scardoni from 𝗘𝗃𝗏𝗁𝗍 tax partner. Right after the Lux CMA was founded, the Direct Tax Working Group sat down and started working on a paper that was supposed to bring a bit more guidance on how the interest limitation rules of 𝗟𝘃𝗏𝗏 apply in a securitization context. That's almost 3 years ago that the paper was issued. Luc, as an auditor, we see quite a lot of securitization companies. 3 years later, how do you evaluate the positions that we took in the paper and the paper's relevance for the market?
Yeah, so to summarize, first, interest limitation rules is about exceeding borrowing cost. So in a sanctioned vehicle, do you have exceeding borrowing costs? So this means more interest expense than interest income. And the question turn around, what is interest income or interest expense? Is not only interest in the legal meaning, but also it is interest income or income which are economically equivalent to interest income or interest expense. And it is where you have some room for maneuver for interpretation. And in this respect, the Lux CMA 4 years ago initiate some discussion about what is interest income or interest expense, because in the past, no one really cares before 𝗟𝘃𝗏𝗏. And when 𝗟𝘃𝗏𝗏 came in, so we look at our section vehicle and we say maybe it will be good to give some thought at what kind of income we get in this vehicle. And so the Lux CMA, so as a catalyst, initiate some discussion with auditors, and particularly from some strategies which are impacted by interest limitation rules, like non-performing loans. And so the Lux CMA gather accounting experts, like Holger and others, to see if when a sanctioned vehicle or non-performing loan, is there a room to consider that the return is at least partly considered as interest or economically equivalent to interest income. And after a discussion under this gap, it has been agreed that when you have a non-performing loan portfolio, the yield you expect at the beginning could be considered as interest income and booked as such in the books of the second vehicle. Because when you discuss with our client when they buy a non-performing loan, usually they do some modeling, and so they compute what they can expect as a return, and usually it is based on the default they expect in the portfolio, and also when they expect to get money. And when you think about it, it's very similar to interest income, because when you lend money, but you get interest for the time you lend money, and also the interest depends on the risk you take. So it's pretty similar to the IRR, and the conclusion was accounting-wise, you could book this IRR as interest income, so not generating any problem for 𝗟𝘃𝗏𝗏. It's just possible excess when you have a surperformance, I would say. this piece of gain will be considered as non-interest income and so captured by interest limitation rules. But the impact of interest limitation rules on non-performing loan is, I would say, less dramatic than initially expected, and this IRR approach, which has been promoted by LuxCMA, help to support this. And we can see also that recently some tax authorities out of Luxembourg endorse this approach. The Irish tax authorities, when they issue their circular last year, they clearly endorse this IRR approach, and they're saying up to an IRR, which is determined reasonably, it should be considered as interest income, only the excess should not be. So at least it seems that the Irish Revenue has read the report or the paper of LuxCMA in the past.
Thank you, Luc. Since the paper came out, the securitization law was amended, and now you can also do securitization through partnerships. We are working on a new paper that is going to look at tax in context of transparent structures. So this is going to be a little preview of that second paper. Geoffrey, do you see a lot of interest in partnership structures, and how do you think the rules would be applying in that context?
Yeah, we certainly see a lot of appetite for those vehicles, and I would say clients are interested, but we are implementing them. So it's not just kind of interest out of curiosity, but it's really a structure which in some instances can really work pretty well. But maybe just a bit of history on this, because obviously this came last year, but already in 2019, when the 8.1 rules came in, we were already starting to look into other alternatives. And the most obvious one, that was the securitization fund. It was tax transparent, so tax neutral, no 8.1 issue at that level. However, I think there were two main downsides for this vehicle. Well, first of all, it was more complicated to deal with, because it's a bit akin to an FCP. It's not as flexible, not as easy to handle as a straight SARL or partnership. So that's the first thing. And the second one is a bit cosmetic, but it's called a fund. It's a securitization fund. And when we are trying to sell a product which is a securitization vehicle, we usually don't want a fund. I take the typical example when you are trying to convince, for instance, the German authorities that this vehicle is not a fund. When there is fund in the name, it doesn't help. It's not the best start. So that's why when the partnership came into play last year, we were quite happy, because obviously it doesn't have fund in the name, it's just a partnership. So it's the better start, but also it's very flexible. I mean, we use the usual SCS or SCSP, very well known, especially the SCSP since 2013 when it was implemented. That's very flexible, and this is something which is easy to implement. You just need a GP, a straight SARL. You will need a unit holder. Similarly to the past, and when we had our securitization vehicles, we were used to have a Dutch foundation, the Dutch stichting on top. You can have it as a unit holder. Once you have that, you have your partnership. It will issue notes to your investors, and you are good to go. I'd say the main difference with the securitization company is that, as I said, it's a tax-transparent vehicle, which is good because no 8.1 issues there. But since it is tax-transparent, you don't benefit from tax treaty protection. So if you need a vehicle which needs treaty protection, that's not the right way to go. But for instance, where we see it a lot, that's for the repackaging of fund units. We see that a lot for, again, German institutional investors. When they cannot invest in the fund directly, we simply repack the units in the fund in the securitization vehicle, which is now a securitization partnership, and they can invest indirectly into the fund through the securitization partnership. And there you don't need treaty protection in most instances. So to answer the question, yes, certainly a lot of appetite, not fitting all requirements always, but certainly something that we can use in practice.
I think in the tax community there were some discussions around the application of the anti-hybrid rules of 8.2 that caused a bit of hesitation in the use of partnerships. What are your thoughts there?
Yes, well, that was indeed legitimate concerns. They are still here, but we received a few weeks ago, actually, some very welcome clarification from the authorities. So just to set the scene here very briefly, because I will not go into the details of anti-hybrid rules, otherwise everybody will run away. But the main rule we are talking about here is the reverse hybrid rules. That's basically when you have a tax-transparent vehicle, which is treated as non-transparent by its investors, by its shareholders. Not investors, shareholders. In such a case, you may lose actually your tax transparency and become taxable, which is not necessarily something you want, because of course we are just implementing a partnership to avoid taxation. I hate myself when I say avoid taxation in the same sentence, but we all see the idea. We implement that to mitigate 𝗟𝘃𝗲𝗏, but we don't want to become taxable again. Now, the clarification we got from the authorities is that if and when you become a reverse hybrid, you will be taxable on your net income, but 𝗟𝘃𝗲𝗏, the interest barrier, will not apply to you. What does that mean? That means that when you have your securitization partnership receiving 100 of income and paying out 100 of expense under the notes that it issues, you are simply flat. And since 𝗟𝘃𝗲𝗏 does not kick in, you don't have any tax issue there, because whilst you became taxable because of those reverse hybrid rules, you, at the end of the day, are flat because your taxable profits are nil. And that's fairly relevant for our typical setup, because I mentioned before, we like to have Dutch stichting on top of our securitization vehicle, simply because we like those platforms to be orphan, not to have any shareholders. And that's something which is achieved by Dutch stichting. However, the Netherlands, they are usually that depends on some conditions, but they may treat Luxembourg partnership as non-transparent. So they may trigger those reverse hybrid rules. So that's why it was quite a concern, and we are very happy to have it alleviated now through these guidelines circular from the tax authorities.
In addition to those transparent structures, there are some old structures that gained new interest as a result of all these complications around interest limitation rules. Sophie, what are you seeing there?
Yes, thank you, Anja. We have seen a lot of possibilities to mitigate the impact of ATAD, and in particular the interest limitation rules that have been explained before. And some of those solutions or structuring options existed prior to the ATAD. And we can mention, for example, the fiduciary notes. So we see a continuing interest from clients on those fiduciary notes, not a big demand, but this is something to keep in mind. So this is, for instance, the case where a securitization vehicle will issue notes on a fiduciary basis, and with the proceeds, it will acquire assets. And those assets that are part or subject to the fiduciary contract or held in the name of the securitization vehicle, but for the account and the risk of the investors. Which means that from an accounting perspective, the assets and the liabilities, so the fiduciary notes, are recorded off balance sheet. And from a tax perspective, which is the interesting part, the rights, the economic rights, are attributed to the investors, which means that income derived from the assets, so funded by those fiduciary notes, is not taxable at the level of the securitization vehicle, and interest accrued on the fiduciary note is at the same time not tax deductible. And this means at the end that the interest limitation rules do not apply to the securitization vehicles that have issued the fiduciary notes. Another solution that we see a lot actually, and there is a clear growing demand from clients, is the possibility to qualify securitization vehicles as alternative investment funds, so AIF. Why this is also interesting, so apart from the AIF qualification, it's because AIF are treated as financial undertakings for the application of the interest limitation rules, and financial undertakings are excluded from the scope of the interest limitation rules. So it appears an easy solution, but not that much. There are some conditions, because obviously to become an AIF, you need to meet some conditions, and you need to keep in mind also the CSSF guidance that was issued in 2013 that said that securitization vehicle that issue only debts cannot qualify as AIF. And which means that in practice, we would rather go for securitization vehicles that are mainly financed by equity for the AIF qualifications.
Yeah, what you just said about the exemption for AIF reminds me of the exemption for the securitization company covered by the securitization regulation, which was challenged by the European Commission. How long do you think that exemption is still going to last?
Yes, that was an interesting exclusion that was provided in the law when Luxembourg implemented the ATAD into Luxembourg law. They added in the list of financial undertakings that are excluded from the application of the interest limitation rules, those SSPE, so the vehicle that are regulated by the 2017 regulation. However, the European Commission considered that this was a wrong implementation of the ATAD, and they asked Luxembourg to remove from the list of financial undertakings those SSPE. And as a result, last year in March, Luxembourg issued a bill to remove those SSPE from the list of financial undertakings, and the draft law, so the bill, indicating that it would apply to financial years starting as from the 1st of January 2023. So that was last year. The State Council issued its opinion, and there was nothing more as from October last year. So it's not very clear when the law and if the law will be passed. It's not clear if it will be passed this year. And so we are not very certain on the date of application. So we just need to keep in mind, obviously, that there is a principle under tax law which says that you cannot have a retrospective effect of a tax law. So I guess that if it still was till, let's say, in December this year, probably the date of application would be as from next year, but nothing is certain.
Yeah, to round up that discussion on the interest limitation rules, we also see some companies that are part of a consolidated group and that are able to deduct all their interest expense as a result of specific rules that apply to those companies. Luc, we mentioned ETA 2 and the anti-hybrid rules already, and Geoffrey gave us a little overview of how the rules would not apply to the transparent structures, but there's a bit more to the anti-hybrid rules. How do you see them applying in a securitization context?
Yeah, for the Anti-Tax Avoidance Directive 2, which capture hybrid mismatch, which consists in situation where you have a deduction claim in one country with no taxation of the corresponding income in another country, or when you have a double deduction in a structure. Usually what we see, section companies are not very impacted by these rules because these anti-hybrid mismatch rules apply when you have an arrangement between associated enterprises, so related parties. And in many securitization companies, the investors are not associated enterprise, they are just creditor, so they have no ownership in the cession vehicle, or they have no voting rights or no right to distribution. So that is why for cession vehicle funded by notes, where investors only hold the notes, we do not see adverse implication. Some structure can still be captured when you have the note holder, which is also shareholder. And in these cases, you need to look at if the note holder is associated and how they regard the notes, how they treat the income derived from the notes in their jurisdiction. And if in Luxembourg we claim a deduction and in the end of the note holder they claim an exemption because they regard the instrument as an equity instrument when we look at it as a debt instrument, there could still be some attached to implication, but in practice, I have not seen it because you need to satisfy some condition of being associated enterprises and so on. So I would say the impact of attached to on securitization company is limited in practice. You need to monitor it, to check it, but usually the conclusion is that there is no issue.
So that concludes the part where we look at the past and the present. Let's now try to look a bit into the future, into the possible future. 𝗟𝘃𝗃𝗃 is looming around the corner. It's also called unmissable. Sophie, what is it, and do securitization companies have to be worried about 𝗟𝘃𝗃𝗃?
Yes, well, actually, probably we can already say the conclusion that probably not a big impact. But before jumping to this conclusion, maybe a short recap on what is 𝗟𝘃𝗃𝗃. So in December 2021, the EU Commission issued the unshell proposal that is also called the 𝗟𝘃𝗃𝗃. And the objective of this proposal is to prevent the misuse of shell entities that have no minimal substance and that are set up in the EU in order to obtain a tax advantage like a reduced tax. So the proposals set a framework, so a common set of rules for determining which entity is to be treated as a shell entity, so which have insufficient substance. And if an entity qualifies as a shell entity, then there will be tax consequences as well as exchange of information between the tax authorities. So to summarize how it works, so without entering into the details, because we could spend some time on this, so there will be reporting obligations via tax returns for an entity that pass 3 gateways. And those gateways include whether the entity has some passive income, has cross-border activities, or outsource the administration of day-to-day activities, as well as decision-making on significant functions. And if this entity passes the 3 gateways, then it will have to report whether it meets some certain substance indicators. This includes whether it has its own premises, its a bank account which is active, whether it has at least one director that is a Luxembourg resident, competent, and so on, and that is not an employee of a non-associated enterprise, or whether the company has a majority of employees that are competent and Luxembourg residents. And if the entity cannot meet those substance indicators, in this case, it will be presumed to be a shell entity unless it can rebut the presumption by providing some evidence like explaining the commercial rationale of its existence. And if the presumption cannot be rebutted, then this is at that time that there will be tax consequences. And the main tax consequences are the denial of treaty access, So for example, for the application of reduced withholding tax rates, or the impossibility to apply the EU directives, such as the Parent Subsidiary Directive or the Interest and Royalty Directive. But before going all those steps, which look a bit complicated, actually there is an easy solution, which is actually to apply the carve-out, because some entities are carved out from the proposal. And this includes first the companies with listed transferable securities, or the EU-regulated financial undertakings such as AIF or the SSPE that we mentioned before. So as you can see, if a securitization vehicle actually has either listed transferable securities or can qualify as an AIF or an SSPE, it would be carved out from the ATAD 3 directive, which is good news. But in addition, so even if it cannot qualify for this exemption, and at the end it passes all the tests, and you go to the case tax consequences, it may not be dramatic if at the end the securitization vehicle does not rely on any treaty applications for withholding tax or whatever. So I'm not sure the ATAD 3 will have a big impact. In addition, this proposal that has been issued in December 2021 has been highly discussed at EU level. There is no consensus yet, so, and we expect a lot of changes, and it's, the level of those changes are not clear, and we, I guess, may expect a lot of news during the next 6 months. It's not yet certain whether it will be voted before year end, but yeah, just expect some news before year end.
Thank you. So we're at the end of our tour from the past to the present and into the possible future. Lots of very difficult technical topics that we had to get our heads around. But I think with a lot of good pragmatic answers to sometimes very challenging questions. Still, I think you will still have tax on the agenda of future capital market days. Thank you to my panelists for sharing your insights, and thank you to all the working group members for helping us reach these conclusions and the debates and discussions. Holger, back to you.
So thank you very much. I've learned that we do not need to be concerned about ATAD 2 and 3, and we still have some homework for ATAD 1, but I think this will also be done. We are now coming to, wait. It's not working. We are now coming to a single topic. We call it Hot Takes and Headlines, which is a small session behind the big panels. And we have heard about the Capital Market Union. And one part of this Capital Market Union package is the so-called EU Listing Act. And we have Paul Péporté, partner at 𝗟𝘂𝗅𝗲𝗄 and leader of the LuxCMA Listing Act Working Group. And he will give us a few insights about the recent changes and the impacts of Luxembourg. Paul, where are you? Ah, there.
Thank you, Holger, and good evening, everyone. So I have 10 minutes to guide us through a quite detailed package that was published on 7th of December 2022. Actually, the European Commission was quite busy in the sense that they have really published a quite long set of future rules which are designed to further develop the Capital Markets Union, and which actually go around 3 key topics. The first one being to create or to essentially make the European clearing services more resilient and more efficient. But also, and the second one, the objective was to create or to improve a corporate insolvency rules across Europe, which would favor more efficient cross-border investments. And then last but not least, the focus point was on really cracking the listing rules that are in place, and the objective was really to alleviate the administrative burden for corporates and especially SMEs, which are struggling to get better access to the capital markets. So I will focus on this EU listing package, and essentially the package consists of a proposed amendment to the prospectus regulation, to the market abuse regulation, and also to the markets in financial instruments regulation. There is also an amending directive proposed as part of the Listing Act package, which is amending MiFID, so the Market in Financial Instruments Directive, and which is also repealing the Listing Directive. And then finally, there is also a proposed directive on multiple vote shares, which are essentially designed for the SME growth markets in order to ensure that shareholders in SMEs can maintain control despite listing. But I will make a selection. 10 minutes is not enough otherwise. And I will start by focusing on the changes to the prospectus regulation. The objective, again, is simplification of the documentation and also reducing costs. And I can say that there are no groundbreaking changes in this commonly known prospectus framework. And in the mainstream debt capital markets area, we can really say that the main principles are going to be kept. In particular, there will be no major changes to the main exemptions for public offers, which is, I think, key. There will also be still a distinction between a differentiated disclosure between retail debt securities and wholesale debt securities. If you remember, some time ago, there was a proposal to basically mix them. So that's not on the table. Again, good news in order to keep our wholesale debt market. There are also no changes expected to the structure of base prospectuses, which again is good news. There are, however, some changes. There is, for instance, a thought on changing risk factor disclosure, on removing the need to rank risk factors by their materiality, well, that would be a nice change, but then this is really just a proposal from the Commission, and actually no later than earlier in June, the Parliament already gave their, let's say, draft report in which they, for instance, said that according to them there should be no change to this risk factor disclosure, so maybe we will be in status quo on that point. There was also a proposal to limit the size of our prospectuses to, at least to prospectuses for equity, to 300 pages, on the grounds that essentially these prospectuses are unreadable for retail investors. But again here, we are now facing the European Parliament saying that actually, according to their statistics, 95% of the readers of prospectuses are actually professionals, and that retail would focus only on a summary. So again, there we are more or less back at square one, in the sense that this limitation is probably not going to fly. There are, however, some changes, also again on the alleviation of requirements. So for instance, on supplements, we will see supplements for some supplements to base prospectuses to update the disclosure of annual financials or interim financials are going to disappear. So again, that will probably reduce costs. And also there will be clarification that supplements cannot be produced to introduce a new type of security in a program. I think already largely a practice, but this will then be enshrined in the regulation. Moving on the summaries to the prospectus, actually no major changes are expected, apart from some minor ones. Another point that is interesting is to see the introduction of sustainability disclosure in our prospectus framework. Here, actually, we are expecting delegated acts at level 2 that are to follow, and it can be expected that there will be some minimum disclosure on ESG topics to be included in prospectuses. It's probably too early to say what exactly this will imply, and it will also be interesting to see to which extent this let's say, Level 2 Act for the prospectus regulation will also take into account other movements in the legislative changes, which are essentially the EU Green Bond Standards, which is also going to be introduced. So we'll have to really see if we have some efficiencies there. And obviously the hope would be that we are not creating an additional burden for issuers with respect to green disclosure. There are a number of other changes. As I said, I will not be exhaustive. One thing to mention is maybe that the de minimis exemption for public offers will be increased from 8 million to 12 million, subject to certain national implementation rules that will be safe-kept. I should also mention that beyond the prospectus regulation, the market abuse regulation is going to be amended. But again, here we talk about changes that are, I would say, rather limited. Again, with an objective of simplifying the framework whilst safekeeping the market integrity. So there will be some changes on inside information disclosure, on delaying the disclosure of inside information, again with an objective to simplify the rules. Let me now maybe spend a few minutes on one particular aspect of these Listing Act proposals that was of particular relevance in Luxembourg, which was in connection with the proposed repealing of the listing directive. This listing directive was actually adopted many years ago, and it created the framework for official listing. And this is a piece of legislation that came out way before the prospectus directive. And since then, I think the European legislator has moved a little bit away from the concept of official listing and has more and more moved to the concept of admission to trading on a trading venue, on a regulated market, or what have you. And I think really listing as a concept was probably a little bit more at stake. However, I think it's also fair to say that in Europe there are still a number of stock exchanges that keep the concept of official listing, and obviously the Luxembourg Stock Exchange does do that as well. And I think probably you all know if there is an admission to trading of securities on a regulated market, then you would also get an admission to the official list of the stock exchange, and there are some merits there. So I think the question mark were, does it really make sense to keep this concept, or should it be removed, as it was also considered as slightly, let's say, it was seen as not necessarily coherent of having two concepts which were used interchangeably. After the publication of these proposals in December at this working group at LuxCMA, we got together in order to prepare response comments to this proposed Listing Act directive, and here the objective was really to find arguments to explain why there is still a merit in keeping the concept of official listing. I think we were arguing that the proposals were very much focused on equity capital markets and were disregarding the fact that on the debt capital market side you can indeed, and you very often have, a mere listing, a technical listing. And I think it was also clear that a listing can still be relevant for issuers for visibility purposes, and it can also be relevant for certain asset classes, such as security tokens, which are not necessarily admitted to trading on the regulated market. I think we proposed some changes, in particular to a recital number 10 in this draft amending directive, and And this was then submitted in the usual frameworks. And I think the positive news is that now we have some form of compromise proposal that was published, which is essentially still repealing the listing directive. So that will probably be gone, but clarifying in this recital 10 that notwithstanding the repeal of the listing directive, it will still be possible to maintain local regimes. And I think that's basically what we have tried to do within the Lux CMA to obviously safekeep this possibility in Luxembourg to keep the official listing and to safekeep the securities official list. So positive news, but it's not yet final. There's still a number of months or years actually to wait until this is final. So future will tell. And that was all. I hand back to Holger. Thank you.
Thanks, Paul. I think it's really complicated what will come, but it will keep the lawyers busy. We're coming now to the next panel on sustainable finance. The sustainable finance panel will speak with us on the theme scaling up for more sustainable finance. The panel members will share a few examples on how Luxembourg Capital Market can accelerate the trillions in financing required for the transition to a more sustainable future. In this panel, you can use now in a few minutes, your iPhones or your mobile phones, because we will have an interactive poll at the beginning. So officially, you are allowed to use your mobile phones during this panel. And the panel is moderated by Carolyn Linnevers, Deputy CEO of Lux CSD and Executive Committee member. She began her career in asset management in New York and has now worked for the Clearstream Group since the early 2000s. At Lux CSD, she is responsible for ESG, sustainable finance, as well as the governance and the control functions. The floor is yours.
Thank you. Do you have the...
I give it to you.
It says... Okay. Why don't we start with these two polls? Because if we continue with our discussion, then you'll know, then we will reveal some answers or what we believe is the right thing. So please go ahead. Oh, they're going quickly. Can I go back? Sorry.
Yes, there you go.
Okay. Does everyone have access to this? Either you can go to sudo.com and put in the number, or you can download the app, whichever you prefer. And then I believe as the answers come in, they will proceed in real time. But while you have a chance to do that, we'll just give a quick intro to what we're planning to do. The main thing we wanted to do today was have a little bit of discussion. Hopefully, we'll be able to do that here with our distinguished panel members to get some feedback from you with this poll. So while we're going ahead and working through these first two questions here, do you agree that the capital markets are key to meeting the EU's climate ambitions? I think I have to wait until the results come up. Why don't you go ahead and do that? In the meantime, I'll introduce the panelists. So I will start on the far right with Thomas Pellequer, who is the Managing Director and Chief Executive Officer of 𝗟𝘃𝗁𝗄 Capital Markets in Europe, SA, which is a newly created European hub of the Canadian Imperial Bank of Commerce, headquartered in Toronto, Ontario. With 46,000 employees worldwide and sustainable finance target of $300 billion by 2030, 𝗟𝘃𝗁𝗄 is an active player in the ESG space. 𝗟𝘃𝗁𝗄 has also announced a 2050 target year to achieve net zero greenhouse gas emissions from operational and financing activities. And then in the middle there is Sven Ulbrich, who is CEO of Fund 2SEC, a securitization vehicle. And we're not going to talk about tax here, I think, are we, Sven? No, we've had enough of securitization tax. Very interesting, though. That's based in Kontern. Since he designed his first Luxembourg securitization vehicle back in 2005, he created a number of different platforms and products to enable investors to allocate alternative investments. During the pandemic, Sven decided to create the Fund 2 Seed, a group of companies in Luxembourg and Germany dedicated to impact-driven financial market participants. His Austrian joint venture partner is a leading investor in a number of impacting asset classes, such as microfinance, real estate, and private equity, and he's frequently awarded for his Sustainable Development Goal initiatives and innovation. And to my right, I welcome Denise Voss. And Denise is a non-executive director of boards of flagship funds, of major fund promoters, and has worked in the financial industry in Luxembourg since 1990. I think you're a familiar face in Luxembourg, Denise, we all know you. She is currently chairwoman of LuxFlag, an independent agency supporting the financing of sustainable development. She is also director of the International Climate Finance Accelerator and vice chairwoman of the IFAMA Investor Education Platform and a member of the 𝗟𝘃𝗲𝗄 Strategic Board. So we're very pleased to have our distinguished panelists here to share their views with us. And is this poll working? It says connection lost, reconnecting, which is never a good sign. Okay. Well, we will just leave that as it is, and if the connection comes back online, then hopefully we will be able to resuscitate our poll. But I think we can a little bit go on with this. Do you agree that the capital markets are key to meeting the EU's climate ambitions? And I think if we respect Mr. Gramegna and the other presentations here this evening, I think our answer to that would have to be yes, obviously. And the second question is how much the European Commission estimates that the EU will need in additional investment per year in order to meet its 2050 Green Deal objectives. And so the amounts that we had given, which I'm not able to show you here, are 250 billion, 500 billion, or 700 billion per annum. Anybody have any ideas? Okay, it's the top number. Oh, do we have our poll back? Okay, so, okay. No, okay. That's declining. Okay, so it looks like we're addressing the right audience here this evening, but we're still out there to convince others who maybe are not along this journey with us, but that's quite positive. And then here's a second question about the amount that's required per annum to meet the 2050 Green Deal objectives. And the majority of respondents have selected 700 billion, which is also the correct answer. So thank you very much for that. It's been a busy first half of the year. For the sustainable finance topics, there have been lots of seminars, very informative, lots of qualified people talking in the Luxembourg ecosystem about what's going on, the different service providers and opportunities. There's also been a number of different publications about sustainable finance, in particular the EU draft sustainable finance package, which is really leveraging the opportunities from the EU Green Bond Standard Regulation and taxonomy alignment. So it is estimated that 700 billion is required each year in order to meet those important objectives. Interestingly, the European Commission indicates that they will finance 30% of this through green bonds, but that the private sector will need to raise about 70% of the capital expenditure in order to meet the objectives of the green transition. So the overall message is clear. Significant investment is required from both the public and private sector to meet the EU and global 2050 climate and economic objectives, as well as the broader 17 UN Sustainable Development Goals. So the capital markets have a vital role to play. So our panel is going to speak today about their personal experiences and their professional experiences for the ways in which Luxembourg is getting ready today to support these future demands. Just as a moderator, I will briefly introduce 𝗟𝘂𝗅𝗲𝗄, the company that I work for, and how this can potentially be an inspiration for other companies to utilize the infrastructures that exist in Luxembourg. So as a regulated stable market infrastructure, we act as a catalyst for sustainable finance initiatives, creating opportunities and trust in the capital markets of today and tomorrow. We are a subsidiary of the Clearstream and Deutsche Börse Group. We offer fixed income and equity issuer services, including efficient dematerialization for Luxembourg and access to other European jurisdictions. We also offer investor custody services and handle our securities trading via the Target 2 securities platform and settlement in central bank money settlement. LuxCSD does have a bit of history, fortunately, with sustainable finance. We had issued the first dematerialized bond for EIB's climate awareness bond in 2013. And in addition, we've handled the 1.5 billion first AAA European sovereign sustainability bond issued by the Grand Duchy of Luxembourg. We also support equity issuers for companies, including those with ESG objectives. We are not a pure ESG company because as a CSD, we also need to be neutral, but we are happy to support this very important capital raising journey. So turning to our panelists now, we've heard a bit about each of your business backgrounds and the trends in the capital markets, but we are curious to know what is your professional and company's experience in sustainable finance and what are the key drivers for opportunities in those markets? Who would like to go first?
Hi, thank you for the question. So as a banker, a credit institution, in the current ecosystem, I would say 3 main business lines which are impacted by sustainable finance. So supporting our clients, obviously, the investment banking / advisory activity where we help clients to set a framework, get compliant with the taxonomy or line in order to navigate that universe of ESG KPIs. We've got also the debt capital market activity where we originate, underwrite, and syndicate those bonds following the existing taxonomy. So that it's mostly to support national and supranationals, issuing mostly green bonds, sustainable bonds. Very popular at the moment are the gender bonds, housing bonds, or climate awareness that we can see making the headline in the newspaper pretty frequently. And the last sector or business line is corporate banking, where we effectively go and lend directly to corporates in order to help them in their journeys. They're not all super advanced in what they're doing. They may want to attach some sustainable or KPIs like key performance indicator and link the cost of their debt or their derivatives to them achieving those goals and targets. So that's an incentive. It's done on a bilateral or club deal basis. Those KPIs need to be ambitious. They need to go behind whatever the regulator is asking in certain sectors. So it's always an interesting conversation with our clients. But yeah, those are the 3 things that we are involved in.
Okay, so since already introduced, I'm taking part of the securitization part, and unfortunately, it's also ATED related, but I don't want to talk about tax. In our business, the main focus is really to enable investors to invest into impact and sustainable assets. Most of the time, these, especially impact assets, are non-regulated or less regulated. They're in underdeveloped markets, they are undervalued, or at least illiquid, or something else is missing what typically traditional assets and asset classes could be done via UCITS fund and so on. So the alternative investment fund area of Luxembourg definitely has a big advantage to this market. Given the constraints of balance sheets, especially in institutional clients like pension funds, foundations, charitable organizations, or whatsoever, equity investments are sometimes limited by risk or by any other constraints, and therefore securitization can play a big part to that. And this is what we've done since a couple of years, and together with my Austrian venture partner. They are an Austrian pension fund investing in microfinance, real estate debt, private equity, which in particular for a pension fund normally is hard to achieve. And securitization can help. And we are bridging the gap between the regulatory needs of investors and the regulatory burdens of impacting assets in particular.
Thank you. Denise.
Thank you. Well, I'll speak about labels, of course, and about LuxFlag, which was created in 2006 to promote sustainable development through the awarding of labels to financial products that meet the LuxFlag label criteria. There is a rigorous review process on a quarterly basis. We review legal documents, policies, procedures, and the portfolios of the applicants. Now, the aim of a label, though, is to give investors comfort that the financial product does what it says on the tin. It's not replacing the regulator, of course, by any means, but it's to give that comfort that what you see is what you get. We have 8 charter members. I just mentioned that because it's important to reference the ecosystem and the evolved ecosystem that we have in Luxembourg. Our charter members includes the Luxembourg government. We have 3 ministries involved on our board. And the rest of the charter members include very familiar names: the European Investment Bank, Luxembourg for Finance, 𝗟𝘂𝗍𝗄𝗏, ADA, so a microfinance consulting and technical assistance organization. And last but not least, of course, the Luxembourg Stock Exchange. We have a thriving associate member program with the goal of sharing best practices, and this we've been doing since it was introduced in the mid-2000s, and it's a very important part of what we do. Last but not least, I'll just mention a bit on the labels themselves. So our first label was a microfinance label. Unlike the other 6 labeling agencies in the EU, they generally have either an ESG label or a green label, climate label. We took the decision to offer several labels, which allow, as we see now, financial market participants to really showcase their particular expertise in sustainable finance. Currently, we have a number of impact labels, such as microfinance and climate finance, and we have what we call sustainable transition labels. Our ESG labels, I like to say it's in 3 flavors. We have, according to the specificities of the financial products, so ESG for investment funds, 1 for insurance, and 1 for discretionary mandates. We're also looking at other labels. So, for instance, 1 specifically related to real estate, which I think would resonate with the investment financial product lineup in Luxembourg. And we've been talking, of course, a lot about the environment, but we also have quite an interesting and new demand for potential labels focusing on social issues. So, inclusive finance, for instance, in addition to the microfinance label. So this is in development with the industry.
Very good. Thank you. It's nice to know a little bit more about what's going on in the marketplace rather than just talking about theoretical or high level or regulatory requirements, but real sustainable finance activities going on. Let's see if I'm able to move to the next poll. Oh, yes, no. Well, we can just go to this one. What information would help to support investors to identify sustainable investment projects or products over their life cycle?
Thank you.
Labels, good. Well done. Well sold, Denise.
Oh, maybe not. Second place. Thank you.
In fact, I think it's difficult to talk about most because probably it's a blend and it also depends on exactly what you're looking for. I think ultimately that's what we are getting at there. Let's see what the next poll. Okay. And the next question, what ways can the private sector better leverage the capital markets to raise capital for reducing the impact of climate change as well as reaching some of the social objectives that we have discussed? Securitizations are popular here this evening. Well done. And to our other panelists. EU green bonds clearly are very important for the objectives of the EU and the standardization. Equities, it's not something that we've talked about much here, but we know that their companies will be coming to raise capital via equity issuance. Maybe at the moment it's a little bit slow, this activity, but let's see what happens as if the market has a little bit more confidence going forward. And in addition, there's also some demand for specialized or alternative investment fund or fund of funds. So again, I think all of those can certainly play a role for the private sector to reach some of these objectives. So for the next question, what do you think, to my panelists, what do you think is driving the demand for ESG-aligned securities and projects? Is it the governments and legislatures? Is it the investors, the issuers, or someone else? Thomas?
Yes, I think when you're looking at the green or sustainable bond market, it's working amazingly well. I mean, everybody believes in what the taxonomy effectively provide and the use of those funds. So when you see a supranational issuing a bond, you will see probably 5-6-fold the size to be oversubscribed. So that is working very well. Which is completely lacking credibility at the moment is the unregulated market, and that is the biggest part of the market that is left for private fund to take care of. So I think a very good example of that is the carbon market. So as you may know, greenhouse gas, 80% of that is carbon dioxide. This market is regulated somehow by government, and there is an allowance or compliance market, which represent worldwide pretty much 25% of all those emissions. It means that 75% of that market is not covered. And when you're looking at what is happening, and mostly what has been trading in that respect is the carbon offset market. All the big corporates that want to achieve net zero will at some point, even if they transform completely their operating model, will have somehow to buy some offset. And if they can't believe or buying those offset creates some big reputational risks, then the investment won't come. And that is what we have to fight against. So I think the biggest, best example, current one, Delta Airline. I don't know if you've seen the news about a month ago. They pledged that they would be carbon zero by 2020. They bought about 27 million tons of carbon offset. And now there is a class action in the States because people think that 90% of those offsets were actually not real or did not achieve anything. So I think for me that's the biggest thing, reputational risk, getting to a standardization.
Mm-hmm. But I think your point is that for most corporates, et cetera, it'll be a blended approach to how they're going to achieve their objectives. It may be a combination depending on what the availability is in the market and what suits their particular needs or projects. So.
Yeah, well, the product needs to exist and be trusted so that
exactly.
people will act upon.
Mm-hmm. Sven?
Yeah, to me, the answer is more or less clear, given that without the private investors, we won't do it anyhow. The governments alone are not in a place, neither by volumes, neither by size, and nor by sustainable timing on different topics. I mean, right now, everybody is about green and carbon neutral. A couple of years ago, we had microfinance driving the force and fight against poverty. I mean, we are talking about 17 goals on the UN level, 169 targets, so there's a lot to do. And the chance of the private sector definitely is that as heterogeneous the 169 targets of the UN are within the SDG field, so the investors are. So there are investors who are interested in carbon, trading carbon. Others are interested in fighting poverty or saving the planet by oceans or whatsoever. So that's, in my opinion, the biggest challenge to make sure that investors find their niche, their interest, and their specific know-how to focus on, because then everybody can profit the most of it. And to me, and therefore the question and the poll was definitely interesting. It's labels. It's not data. Data are available. Data are available today already. There are statistics about everything, about poverty, about mortal rates due to poverty, due to pollution, due to climate changes, whatsoever. However, the interpretation of these data is the most key point, which can help to focus on different items. And labels are interpreting in a way. And yes, of course, you can agree that the Lux flag interpretation of whatsoever data is okay. You can agree on different scientists like Björn Lomborg or whomever. You don't have. You can also disagree, but the main challenge is really to get into work and stop arguing about whether the interpretation right is correct. And therefore, to me, the private investors is key. However, of course, we need a regulatory framework, and that's, in my opinion, the challenge on the governments to really set this framework best.
So I think consistency and transparency and building trust in the markets is key for all of this if investors are going to continue to be enthusiastic about investing via the capital markets. And Denise, I think we have probably only about 5 minutes left, so I think we'll skip our last question, but if you could please elaborate on this one, because clearly you have an important role in this area as well.
Mm-hmm. To your very good point, I mean, people use SFDR as a label, and it's not a labeling system. It's transparency disclosure regime. But the EU Commission is going to be reviewing SFDR, and if I look at what's happening in the UK, which is using a labeling regime, I wouldn't be surprised if we didn't end up with something like that, because, again, of how people naturally kind of are using SFDR. So certainly on the regulatory side, I mean, I think the policymakers, the regulators, they have a huge role to play, of course, but certainly from a financing, budget point of view, it's the private sector that we need really behind it. And I think it's interesting. I think we obviously also see the general public is pushing. I think the vast majority of people accept we are in a period of climate change. And I actually remember when Minister Gramegna, when he actually had attended an event in the EU and he was speaking at a conference that we moderated, and he said, I don't say climate change anymore. I say the climate crisis, because we are in a crisis. And I think the vast majority of people would recognize that. Many live it. This is why they recognize it. But coming back to regulation, I think that individuals, investors in the EU who invest now as a result of MiFID, in many cases, are being asked by their financial advisor what their sustainability preferences are. So the demand for ESG and impact products is also coming as a result of this legal regulatory requirement for asking about sustainability preferences. And it's not difficult to see that a financial product with an ESG label or a climate finance label could help financial advisors match their clients' sustainability preferences with a selection of financial products.
So thank you for the information about the demand. We'll have to come back another time to talk a little bit more about the challenges of meeting this demand, but we look forward to doing that. Perhaps just a quick takeaway from each of you, what you would like our participants to go home with after this panel.
Do the same order?
No, I think for me, definitely standardization, transparency, making sure that the product or what's going to be made with the money is understood and is traceable. I believe that DLT or tokens will help with that process in order to get kind of an audit trial. But the idea is to develop something which is effectively, trustable, put it this way. So I think, and the unity idea that was also discussed originally, having equivalencies, because 1 ton of, sorry, I'm sticking on my carbon thing, but 1 ton of carbon in Luxembourg is 1 ton of carbon in the States or in Asia. So there is no reason why we couldn't, get to a unified market.
Thank you.
Yeah, my takeaway is really that we should try to get Luxembourg back to where it was a decade ago or maybe 2 decades ago, to be a market player who is very active, very fast. Time to market is key. And to me, this is a big chance for Luxembourg, being that great kind of network as we have today here. It's a big chance if we don't discuss too much the best way, but we keep it trying. Let's try it. And just as a takeaway, unfortunately, I was said it was 250 people coming today, so I haven't ordered 250 books, but there's, to me, a lot of great things to read out there. One of the best books, in my opinion, actually is Best Things First. So it's an action plan of what kind of actions could be done very easily, very fastly. it's not necessarily on investing, it's just on also non-profit organizations and so on. And I have left 10 books on the top, so if the first 10 who go out can pick it up. No,
Best things first.
Yeah.
Great. Denise.
I think it's important to note that ESG and sustainable investment are, for most of us, new. And it's a new topic, and it needs to be understood and as such, i.e. we need to put, it's not just another asset class, it's a new topic, and we need to put the time to learn, to read, to educate ourselves, to educate everybody, actually, which is not a topic we talked about, one of the challenges. Again, I think we need to remember why we're doing all of this. So again, referring to the planet, people. And the stakes are high, but there are great opportunities out there. Obviously, opportunities in making the planet better for people as well, but also great business opportunities. So I think that's important. And I like to end with a quote from a reverend in the UK from a long time ago, Sydney Smith, and it's the greatest of all mistakes to do nothing because you can only do little. And I think, in fact, we can all do a lot.
Great.
So, thank you.
Thank you very much. We look forward to speaking to you after the event and the networking cocktail. Thank you.
Thank you, and sorry that the poll does not work probably at the beginning. We are now coming to another hot take, 10 minutes on EMIR. EMIR is the European Market Infrastructure Regulation, and it's a key piece of legislation that aims to enhance the transparency, stability, and efficiency of the derivative market in the EU. We have many obligations on reporting and clearing and so on, and the CSSF has a crucial role in overseeing and enforcing these obligations in Luxembourg. We have the pleasure to welcome Andrea Gentilini from the CSSF, being interviewed by Philippe Noeltner from 𝗟𝘂𝗅𝗲𝗄. Andrea has led the division that oversees the financial market infrastructures at the CSSF since 2017. He also coordinates the CSSF work with ESMA and takes part in several ESMA committees. And since this year, since March, he became the chair of the ESMA group on post-trading issuance. Andrea has worked also at the CSSF since 2014, but also on the financial market before for 15 years in Luxembourg and in China. Philippe is a legal expert in derivatives, securitization, banking, fintechs, regulations, and innovative products at 𝗟𝘂𝗅𝗲𝗄, and member of many associations and many also working groups on fintechs, so that he has a close eye what's going on the market. Philippe, Andrea, it's your turn.
Well, thanks so much, Mr. Gentilini, for being here and for sharing with us some of your expertise on derivatives. So we prepared actually a series of questions where we're going to cover sort of the most relevant and hot topics happening today in EMIR, such as reporting, clearing obligations, and last but not least, supervisory and sanctions. So we hope that this interview will bring some clarity to some of the players here in the audience, but as well understand that Mr. Gentilini and his team will stick around for the networking cocktail, so maybe there'll be some follow-up questions over some glasses of champagne. So my first question is really, well, how do you assess the data quality that you received? So when you assess the trade repositories, and as well, then what are the main challenges and gaps that you encounter, and how do you deal with them?
Well, first of all, many thanks for the invitation. Just to remember that CSSF has developed a series of data quality indicators to identify data quality issues. We at CSSF have participated to the ESMA data quality review since the beginning, so since ESMA launched this effort-based exercise. And this has been complemented by specific ad hoc controls and the introduction of the CSSF Data Quality Action Plan, an exercise carried out between 9 and 10 times per year, based on 17 indicators. And I take the opportunity here to thanks, as you mentioned before, the people in my team, especially 𝗟𝘃𝗲𝗁 and Bastien Riot, who have extensively worked in those years in order to define not only the approach of the SSSF with good input and a strong contribution, but also they've complemented the action taken by ESMA. And in particular, Mr. Riot worked last year with the ESMA task force, reporting task force, in order to develop the new framework, which is based on, let's say, a set of 19 indicators, and somehow we could say that the SSSF approach of multiple indicators has been in somehow embraced by ESMA, with the new called data quality engagement framework, which is a complex, let's say, a more complex approach that aim in particular to improve data quality, because we have to remember that there are many NCAs and other authorities that look at EMIR. So SSF has immediately developed also these 19 indicators in order to have our own dashboard, and these, thanks to the contribution of our colleague Stephanie in our team, has been produced in a very simple but very intuitive, and those that have attended the recent joint SSSF and CA conference or have looked at our website where we published the presentation that we presented during this 3 days conference, have a clear idea of how intuitive and complete and comprehensive dashboard we can leverage on. We can share also with our colleagues within the SSSF, because indeed each SSSF department is responsible for the supervision of EMIR obligation. So we deal on, in order to identify and monitor data quality issues, we contact supervised entities when major issues impacting the use of data at EU level are identified, but we also leverage on these indicators to contact Luxembourg entities responsible for major incorrect reporting. And let me just remind that the Luxembourg market is highly fragmented. We have approximately 1,000 entities, single entities, that cover the 80% of the market. In other jurisdictions, the number is much lower, which simplify the work of the competent authorities. And in terms of major challenges and gaps, we observe that entities are not conscious about the data reported on their behalf and do not necessarily verify that the quality of the information reported. This leads not only, let's say, to wrong data and difficulties for NCA to leverage on those information, but provide incorrect representation of the real activities of the entities. And just to conclude, sorry, we are conscious that the remediation of data quality issues involve the delegates implicated in the process, and this leads to significant challenges to ensure a permanent correction.
But just to flag on that, so we all know that if you're a financial counterparty, for example, trading with another financial counterparty, there you have a right to delegate this reporting obligation, but you're still on the hook, let's say, as from a legal point of view. But now, let's say for non-financial counterparties, then is it still their obligations to actually check what has been delegated based on mandatory legal provisions?
The point is very important because, and we have observed in terms of non-financial counterparties with our activity in supervision, because we are responsible, myself and mainly my colleagues are deeply involved in supervision NFCs. Indeed, what we observe is that entities, NFCs, do not leverage on data, meaning that they simply limit themselves to trade the derivatives, confirm derivatives, reconcile at portfolio level, and then they leverage on the mandatory delegation. What they miss is the possibility, and this is a gap that will be closed by EMIR refit, is they miss the opportunity to look at the data the financial counterparties report on their behalf in order to check consistency. What we have observed very often is that, for instance, they think, or they've confirmed swap, but in reality swap are not reported as such. And so leveraging our reporting data will enable corporates to perform on a regular basis, not every day, of course, but consistency check, which is also a way to measure the ability of the financial counterparties to provide good services, because sometimes between, I will say, what is promised or what is sell, what is really in reality done, there is a big gap.
That's right. So it's a bit counterintuitive to the fact that even though they're not legally responsible, they're still going to be encouraged to actually look what they're trading, how they're trading, and what they can do with the data. Now coming sort of to you, and I guess it's a big fear of a lot of players because you hear about EMIR. A, it's very complex, and B, we know there's no concept of materiality under EMIR. So that means that any single breach could potentially lead to a sanction. So there, I think, maybe we would hope if you speak plainly, sort of what actually triggers a fine to be issued, because we know that the CSSF has fined in a very public manner specific, well, it was financial counterparties so far, but sort of what do you take into account before fining an entity?
Well, let me take a step back and to grab a few minutes just to say that we need to look at the recent past. What link the crisis of UK pension scheme, the turmoil on Credit Suisse, and the domino effect on US regional banks triggered by SVB. Indeed, somebody could say huge redemptions, but those huge redemptions are due to the loss of trust. EMIR has introduced more than 10 years ago as a response to the financial crisis and the problems triggered by the default of Lehman, another victim of the loss of trust. So we must remember that any regulation, in particular EMIR, is an enabler of good behavior. Therefore, fail to comply with the reporting or clearing, margining, and other things imply that trust is impaired. And the past can be repeated. So it's our ultimate interest of any market participant and of NCAs that when they enter into the derivative market, they do in an appropriate way, which is the ability to identify, measure, and monitor the risk that an entity is exposed to or that is spread into the market. And in terms of the question on the specific issue related to the sanction, and I want just to, let's say, to quote what has been mentioned by recently, well, several times by our Director General Claude Marx, and even recently by Mr. Faber, which said, we favor prevention over repression. We don't get up in the morning with the intention of hanging on fine or penalties entities that have problems. Ultimately, a sanction is a failure. It means that the entity does not have the right process or governance in place to meet the need of the regulation. So our intention is not to sanction. In our ideal world, there would be no sanction at all. Not because we close our eyes, but simply because entities understand the goals of the regulation, don't apply regulation as a simple tick box exercise, and therefore they achieve in their own interest what is the ultimate objective of the regulatory framework.
Because from what I hear, let's say at cocktail parties, etc., is that actually EMIR is so complex, that it's thousands of pages, it's full of, Russian doll-style regulations that simply it never ends and you can never really fully grasp what is actually applicable. But so I sense that there's still, a bit of leeway sort of to really check that there is a trust in there and that the parties actually need to be also of good faith, right, in trying to implement as much as they can EMIR, but as well to be responsible themselves. If that's...
Yes, I will simply use another sentence, which let's say, was a clear and a simple synthesis made by an executive in an entity that we supervise, who would want to eat in a restaurant that has a dirty kitchen. So at the end, simply, apply regulation is not, you are not paying an effort or say a favor to the regulators, to the supervisor. Applying good regulation in order to avoid, first of all, over-regulation, is in the interest of the market participant.
So if I hear you well, if you're an NFC and the FC is not correctly reporting, the idea would be to simply switch to a better service provider.
I can answer it with example, a real case discussion. We had interaction. We launched last year an exercise to address inconsistency because NFCs report financial, non-financial, and the corporate sector. We have contacted a number of entities, and among them, one was, important industrial group, was able to replace the financial counterparties major European banks because they reported their financial sector, let's say the corporate sector, in an inconsistent way. And for them it was, let's say, an element of not taking into consideration appropriately the level of services that they pay for. Because indeed when NFCs trade derivatives, this is not for free. And then it's really a matter of ability. Another NFC was able to address big and major wrong reporting and multiplication of data because of an error made by their financial counterparty within 1 week. So at the end, this evidence that if there is a willingness to do, every year is possible.
Okay. So last question, and we'll be quick because I know we're over time, but sort of I note that obviously the CSSF doesn't operate in a vacuum. This is an EU regulation that's directly applicable in every EU member state. So how do you share the data? Is there a cooperation between different authorities?
Yes, indeed. Well, as I said, there are more than 50 authorities and institutions that look at the mere data. So each of them with its own perspective and mandate. So there is no one single field that is less relevant than the others. First point. Then we strongly cooperate within ESMA framework. As mentioned before, task forces, working group for reporting, policy, supervision, etc. But in addition, I want just to mention 2 examples. At European level, ESMA level, a task force was established a few years ago and produced an extensive report available only for NCAs to enable all NCAs to look based on the same indicators to perform a real data-driven supervision and ensuring supervisory convergence, meaning we enable all NCAs to have the same pair of lenses. And the second element in terms of national cooperation is the strong cooperation we have with the CA and the success of the joint conference we had in early June was a real example of this strong cooperation.
Well, perfect. So now we have a bit more, let's say, information. And again, I understand you'll be sticking around for the networking cocktail, so we'll keep that conversation going.
Thank you.
Andrea, Philippe, many thanks. We're coming now to our last panel. It's digitalization, exploring challenges and opportunities in a rapidly evolving landscape. The channel will be driven by 𝗟𝘂𝗅𝗲𝗄, a senior associate in the Luxembourg office of 𝗘𝗃𝗄𝗅𝗄. She specialized in banking and financial services regulation with a particular focus on fintech and new technologies. 𝗟𝘂𝗅𝗲𝗄 will be joined by the leading financial sector professionals for thought-provoking discussion on the current state and an outlook for digitalization in the capital markets and more specifically the use of DLT for facilitating the securities lifecycle. The floor is yours.
Thank you very much, and good evening, everyone. I reckon that we are the last panel keeping you from the cocktails, so hopefully it will be interesting enough for you to be paying attention to our discussion. So what we'll be focusing and what we'll be discussing today is digitalization. Digitalization is one of the key elements, actually, for supporting the objectives of the EU Capital Markets Union. And although discussions on digitalization have been ongoing at EU level and also at Luxembourg local level since now several years, and we also have seen that number of major issuers have issued DOT securities, like, for instance, the European Investment Bank. The DOT securities market is not mainstream. In today's panel, we're actually going to try to discuss one of the cornerstones, so what are some of the cornerstones and also some of the roadblocks that issuers and other market players are seeing when they actually try to use digital means, and more particularly DOT. For this purpose, I'm joined this evening by different experts from the field with variable experience, and I'll try to present each one of them quite maybe briefly. Next to me sitting Robert Koller. He's the CEO of 𝗟𝘂𝘅𝗲𝗄𝗧. He's also a German qualified lawyer, also qualified in Spain and in England. Then next to him we have Amy Nagata, who is the CEO of Bitflyer. She has actually over 15 years of experience in the finance industry and holds a degree in law and an MBA from HEC Paris. Next to Amy, we have Arnaud Delestienne, who is member of the executive committee of the Luxembourg Stock Exchange. Arnaud holds a degree of economics and finance and has over 25 years of experience in the Luxembourg financial sector. Then we have Nguyen-Motte, who is a senior counsel at DWS Investment. She's a German qualified lawyer, and prior to joining at DWS, she was exercising as a lawyer in Luxembourg. And maybe last but not least, we have Matthew Bentz, who is a general counsel at 𝗟𝘂𝗅𝗲𝗄𝗧. Matthew is a US-trained Luxembourg-based lawyer, and he has vast experience in securities, finance, and certainly the use of DOT, and we'll be very happy to hear each one of our panelists and their views on the use of DOT. Maybe to set the scene, Robert, 𝗟𝘂𝘅𝗲𝗄𝗧 is a cloud-native transaction platform. In your experience, how open are issuers on using digital means, and more particularly DOT?
Yeah, I think, thank you very much, first of all, to 𝗟𝘂𝘅𝗲𝗄𝗧 to have us here and you to moderate this. I think one needs to distinguish between digitalization and DLT, because obviously digitalization covers all of this, but DLT is a subgroup of it. And I think generally we're seeing a trend to digitalization in any possible way, which is something that is unstoppable, especially in capital markets. We don't expect to go back to fax or telex in the next 20 years, rather the contrary. And in DLT, we see there's a huge interest. There is a lot of experiments going on, but it's a huge effort to change such an established infrastructure that has grown over the past decades. And I think Arnaud will be able to tell us more about this. And luckily, you're a non-lawyer here also on the panel. So there's interest where we see to create more efficiencies, to get closer to investors, and to see where we can improve the processes that are currently in place.
Thank you, Robert. I understand there is interest, but still some way to go. Maybe in this area, Arnaud, we already heard previously that the Lux SE admits DOT securities on the securities official list, which is quite welcome, I think, by issuers and also other market players. What are, in your view, the main opportunities and maybe the main hurdles in terms of digitalization, and more specifically, the use of DOT that issuers who would like to issue and offer securities in Luxembourg are currently facing?
Well, I'll start by underlining the tremendous work that has been done by the authorities, the lawmakers, with the support of the capital markets community in basically adopting or transposing the DLT dimension into a core set of domestic laws, because the fact that in Luxembourg you're now able to issue DLT securities, to custodize those securities, to transfer them, to use those DLT securities as collateral, puts really Luxembourg in the lead in Europe, and I would even say on the global stage, actually, when it comes to capital markets innovation through DLT adoption. So I think it's really a fantastic work that's been done. Now, that's the basis. We now need to collectively find a way to make use of this advantage. This is what pioneer issuers like the European Investment Bank has been doing. This is what leading global banks like HSBC with their Orion platform have been doing. This is what market infrastructure like ourselves, we've been trying to take advantage of that, combining this also with the flexibility that Luxembourg law provides us with the official list that Paul mentioned earlier. So slowly but surely you can see that the different pieces of the puzzle are falling into place. Are we yet at a stage where we have products ready off the shelf we can give to the global capital markets to make use of them? Unfortunately, I don't think so. I don't think so for several reasons. First, we're still at the very early stage in terms of understanding how this technology works, what it can deliver. It's going to take some more years, I'm afraid, before we really have solutions that can be adopted by most other players. It's not a showstopper, but this is the reality of where we stand today. And so there are different things we can do to try and progress towards that objective of providing off-the-shelf solution. Cooperation, I would even say it doesn't mean we cannot compete. Co-petition is probably the best word here. We need to continue working together, particularly to fight the risk of fragmentation. Because what we observe today is that the few examples we've seen are all operating on different DLTs without connectivity to each other. So the risk we face today is a risk of fragmentation, which can be very detrimental to the DLT adoption. So we need to get better at working together, developing common standards, really a common foundation, principles that can be leveraged. And connectivity is not only a matter of connecting between the new platforms, right? It's also a matter of how you ensure interoperability with the legacy environment, because not everyone in this market is going to move at the same speed. And so you cannot afford to leave part of the market just out of these transactions if you really want these to become mainstream. So this is a very important point. We also need major pieces that are still missing. There's no credible cash-on-chain solution. And if you're really serious about talking about efficient markets, safe capital markets, you need to have a simultaneous exchange of cash and security. So that's the basis. You need to get there. You need clarity, absolute clarity on settlement finality rules. So there's still a lot of work to be done there. And in Luxembourg, we're working towards moving beyond just the pure listing dimension, admitting those securities to trading. Well, if we want to work under the Luxembourg framework, we have one missing link here, which is we need a CSD that is able to operate in that environment. So you see, there are still many steps that need to be taken before we're able to provide a real attractive solution.
Thank you, Arnaud. Indeed, I think interoperability is certainly a key point that we're seeing in different mentioned in different papers, and the single currency package that was published earlier will certainly maybe address the key point that you mentioned on the cash on chain. There is actually quite a lot of expectation when preparing this panel. I think this was one of the questions raised by one of the speakers, actually on the investment funds industry, and investment funds actually maybe issuing DOT securities, but not necessarily also investing in DOT instruments, be these DOT securities or other crypto assets. And I think we also, in the US, there was an announcement that BlackRock will actually try to launch the first spot Bitcoin exchange-traded fund. Let's see what the SEC has to say about that. But 𝗟𝘂, what would you think, would this actually happen in Luxembourg anytime soon? Not necessarily with Bitcoin, but maybe with another DOT security or maybe a crypto asset, if we go a bit more wild.
Yeah, I wish I would have that crystal ball to answer your question properly to say, but I think it's a core belief that we see at DWS that tokenization of the financial economy brings benefits, obviously. Also, it is our understanding that currently the cryptocurrency is the dominant digital asset, which is really coherent on the market, and there's a tangible client demand in investing into cryptocurrencies. However, I believe, and DWS, we see that there will be a shift potentially on rather focusing, tokenizing liquid and illiquid assets, and that it then will be predominantly then seen on the market in Luxembourg. But then investing in cryptocurrencies, obviously, to face the client demands, you need to have a secured, convenient, a reliable access granted to the clients. And crypto products, on the other hand, will then help also then obviously enable tokenizing assets because there is a similar infrastructure, there is the similar partial regulatory framework to that, which can then be used. So we see for sure there's potential in the next coming years for Luxembourg. We are watching, obviously, global trends very closely. Looking at BlackRock, noting that the SEC has coming back with some of questions, so they are not fully convinced. That's already interesting to note. But then if you see that investing in DLT, there are already examples in Luxembourg, digital bonds, obviously, just to mention that. But then issuing shares using DLT, we haven't seen any tangible examples yet, even though it's in principle possible. So if you look at the blockchain legislation in Luxembourg or the 𝗟𝘂𝗶𝘁 in Germany.
Indeed. Thank you, Theo. Maybe to build upon what Arno mentioned and settlement, Matt, 𝗟𝘂𝗃𝗄𝗅 is actually a pioneer in facilitating the settlement of securities lending transactions using DLT. What, if you were to actually advise, what are the main arguments traditional financial sector actors involved in the securities lifecycle should consider when they decide on whether to actually onboard the DLT solution or not?
I think that, and we at 𝗟𝘂𝗃𝗃 think that it can be reduced to a simple question of what is the value proposition and what is the cost of doing business as usual. We think at 𝗟𝘂𝗃𝗃 that we have a good and clear value proposition for using DLT to facilitate securities finance transactions, to facilitate their settlement. You can be more precise in when you choose to settle. You have greater control over your collateral. All of this and more can save you money, free up capital, free up resources. Of course, that doesn't come overnight. That can't be implemented overnight. There is a cost, an investment within your organization to implement DLT, to move from business as usual to DLT. And of course, there are increasing regulatory headwinds, you might say, as regulators realize how quickly DLT is being taken up, as headlines are generated by other DLT-based things, Bitcoin, that sort of thing. This generates regulatory interest that requires our clients and anyone looking to adopt a DLT solution to be ready to engage on that level. So you've got to weigh those two and decide if the value proposition is truly worth it. That's the 𝗟𝘂𝗃𝗃's view.
Thank you, Matt. Arno, you mentioned actually earlier that we need a CSD in order to have DLT securities admitted on trading. Well, we now have the pilot regime, which is in force. What is your view that the pilot regime will solve maybe the current illiquidity of DLT securities? And maybe could you give us a sneak peek on whether the Luxembourg Stock Exchange is actually thinking of applying for operation under the pilot regime?
We're 3 months down the route, right? I think it was, the pilot regime came into full effect in March 2023, so probably too early to draw conclusions. However, from the many discussions we've had with the market players, there are a number of limitations that and risks that come with the pilot regime that doesn't make things easy at all. You have the uncertainty around the fate of the pilot regime, whether it's going to be maintained, changed, discontinued, so it doesn't help really investment cases. You have very strong limitations on the size, the type of instruments, the size of the instruments themselves, and the size of the infrastructure itself. Just to give you a number, so the infrastructure that would operate this under this pilot regime cannot exceed a total counter value of 6 billion euros in terms of instruments. So you would, very quickly reach the maximum you can operate, and honestly, building a business case on those type of parameters is quite of a challenge, which may explain why actually we don't see a lot of movements under the pilot regime now. And again, too early to draw conclusions, but certainly these are elements that come back regularly through the discussions we're having. That being said, on the Luxembourg Stock Exchange side, we take all the necessary steps to prepare to admit securities on our markets, whether they're issued under the pilot regime, or whether they're issued under the Luxembourg framework, or whether they're issued under a different framework. The important point for us is to be able to make these securities tradable on our markets via the existing platforms, so that we can onboard, we can make the securities available to the greatest number of market participants. And I'm back to the point of fragmentation I was mentioning earlier. We need to find ways to connect to participants that are today using and are used to their own market access channel. If you really want DLT to start being adopted by a broader number, you really need to build those bridges. So that's the kind of direction we've taken so far. And we obviously see where it leads us in the next coming month.
Thank you, Arnaud. Continuing on the trading venues, Amy, Bitflyer is a major crypto assets exchange and one of the first regulated in Europe. Based on your experience, for trading venues who would actually like to admit to trading DOT instruments, what would you say are the key elements they should consider?
Yeah, I will keep it very short because I know we're in front of your people who are thirsty and hungry. So I would say there are three things. One would be the regulatory compliance, because obviously, as Arnaud mentioned, the industry is very young and the regulation is ever changing, and policymakers are still discussing what is the right way to go. So we need to make sure that, or the companies need to make sure that they follow the new, all the news of the industry, the development and the regulatory development. Also, not forgetting the traditional part of, obviously, AML, KYC, in order to protect investors, and that's very important. Second point would be security. That is because obviously the DLT is a digital asset, and the way we custody things would be different potentially from traditional asset. And it is very important to understand that, well, as we all saw in the recent, not so recent anymore, but like FTX or other companies collapse, there's very high risk related to this online digital thing going on. So, for example, at Bitflyer, we're a Japanese company, or we're headquartered in Tokyo. In Japan, some of you may know, but they have one of the strictest regulation in terms of crypto industry. And there, they have to, all the exchanges that have a license there, we have to keep the crypto asset in an offline cold wallet at any moment in time, more than 100% of the client asset. So, well, obviously, in addition to the fiat being kept in a trust account. So that kind of, how do you say, security that will protect the investors, I think it's a key element, and which will develop further in other jurisdictions as well. Thirdly, I would say it's talent, because it is a very complex industry and a lot of new technologies, new jargons, a lot of new things, and not a lot of people in the traditional world fully understand what's going on. So I think it's really important for the companies to make sure that they have the right talent and they keep educating their talents, because it's changing in an incredible speed. So everybody needs to be up to date. And if you don't watch the news or anything for, let's say, a week or 2 weeks vacation, things may have evolved in a very different way. So So I would say those three things are the key.
Thank you, Amy. Completely agreed. Maybe very briefly, Matt, Robert, each one of you actually part of companies that are currently operating and are successful and provide digital means to different market operators. What would you say about the existing legislation? Would you think that it fosters innovation based on the fact that you're actually currently operating on the existing regime? Maybe starting with Robert.
Yeah, I think regulation has an important role to play, and I think it's there because it evolved over many decades or even longer. And it's something we shouldn't just throw away because there's a new asset, a new toy. So I fully agree with what you said. Even in sandboxes, I mean, we applied to one of the regulatory sandboxes, and after 9 months they told us we cannot use it, and we were devastated. We asked why, and they said, well, you comply with all the regulations, so you don't need a sandbox. And I think that's part of the DNA, and we shouldn't do shortcuts. I mean, we can do experiments. Experiments are needed, but once you roll this out in a broader way, it's really important to follow these regulations, to have a regulated marketplace, to have not like FTX or similar things, which comply with all those requirements that have been established for good reasons. So I think it is tough, it's expensive, it is difficult to comply with, but I think it's necessary, and especially if you're in institutional space, institutional investors expect a regulated environment.
Thank you, Robert. I think trust indeed was something that was mentioned earlier. Matt?
Yes, speaking about Luxembourg as a jurisdiction in particular, I can say that our company, 𝗟𝘂𝗅𝗲𝗂𝗃, made a conscious decision to be based here. We were formed originally in the US and then re-domiciled to Luxembourg for a variety of reasons. But one certainly was the regulatory environment here, which seemed conducive to building a business based on the vision that we had for using DLT to accelerate collateral mobility and to facilitate the settlement of securities lending transactions. And that starts with the key regulatory bodies, certainly. We are not currently regulated by the CSSF, or the BCL for that matter, but we have a strategic partner in Clearstream International that is indeed regulated, and we are well aware of the industry in which we operate, and so we've had a good dialogue from the start with those regulators in conjunction with Clearstream. And it's a good dialogue. They're forward-looking, and also understanding of new technologies such as ours, which we find very, very positive indeed. We are constantly scanning the horizon with the help of Boyka and her colleagues at Clifford Chance for other regulatory developments of note, be they within Luxembourg or Europe more broadly, markets in crypto assets, for example. And we also have a particular challenge, you might say, of explaining how we at 𝗟𝘂𝗅𝗂𝗃 and the service that we offer does not touch on digital assets, as that term can be defined by different regulatory frameworks. We're helping to facilitate the settlement of transactions and exchange ownership, but not digital assets per se. So it requires very careful descriptions, a lot of work by me as a lawyer in the company to make sure that we are getting those descriptions right. But at the end of the day, we're very happy indeed with the regulatory environment here in Luxembourg for DLT.
Thank you, Matt. Maybe conscious of time, 𝗟𝘂, what are the 3 key elements asset managers should take into account when they invest into DLT instruments?
Yeah, so if you ask me like this, so number 1 is clearly client appetite is there the interest in the risky cryptocurrency? Are they rather looking tokenized traditional liquid and illiquid assets? So that is something that we are looking about. Then second, we are looking at the entire asset management ecosystem. So obviously we are not just the asset manager, we are working with partners, distribution partners, custodians, and so on. Will they also then doing the shift to be able to use DLT and then enabling obviously such investments? And then 3 would be the legal and regulatory framework, obviously setting the scene in order for us to perform.
Thank you, 𝗟𝘂. And actually building upon what you mentioned, client interest, Amy, to finalize, we see that there is the legal framework. We see that actually market actors are interested. What would you say about institutional investors? Do you think that they're actually interested in investing in crypto assets or actually DOT securities?
Yes, I think there are increasing amount of interest in investing in, obviously, the TLTA instruments, but I wouldn't say it's yet at the mass adoption stage. And in order for that to further grow, I would think that there are different elements that are still needed. One of them would be the infrastructure. As 𝗟𝘂 mentioned earlier, we really need to make sure that there's institutional grade infrastructure that people can feel safe and rely on. That's really important. And also growing acceptance and recognition from all the players, not only the regulators, banks, but corporations and mass retails and everybody. So that is key for the investors to feel comfortable getting into the field. And obviously, most importantly, as we all, I think, mentioned, regulatory stability, because without that, they will never dare, get in and feel comfortable investing. Because if the regulation is unstable, you don't know what's going to happen the next day, and suddenly we don't want to be the next Binance, if I may name them. So yeah, those 3 things that I would mention.
Thank you, Amy. Maybe just to close, certainly digitalization is a passionate topic and the use of DOT even more. Let's see in a year time where we get to, and maybe we'll see also the DOT pilot regime and what's happening there. Well, thank you very much, everyone. And we are getting back to 𝗟𝘂𝗅.
Many thanks for the perfect timing. I have now the pleasure to introduce 𝗟𝘂𝗅𝗲. 𝗟𝘂𝗅𝗲 is our vice chair and head of capital market at TMF, and she will just say a few words before we can enjoy the cocktails and the food.
Thank you, Holger, and good evening, everyone. Once again this year, I have the pleasure and the honor to close this event with some words, and I promise I keep it short, conscious of timing. I would like to first thank everyone who has contributed to this second edition of our Luxembourg Capital Markets Day, and express my gratitude to Mr. Pierre Gramegna for his inspiring words on the Capital Markets Union, our keynote speakers who have shared their highly interesting point of view with the audience, our moderators, thoroughly well prepared, who set the stage for good discussions on some important topics of our capital markets industry, the speakers themselves, whose in-depth knowledge were pivotal for making these discussions a success, Sylvie Meyer and the entire European Convention Center Luxembourg team, as well as Michael Emmon and the Apex team for assisting with the overall organization of this event. And last but not least, the audience showing the great interest in our capital markets sector. It has been an insightful and productive evening, filled of engaging discussions surrounding crucial topics of our industry. The panel on securitization vehicles and ATAD directives provided us with a valuable overview of the past, present, and potential future implications to be considered and sometimes complex. Discussions on sustainable finance reaffirm the importance of integrating sustainable practices in our capital market system. As the demand for sustainable investment continues to grow, it is vital that we develop innovative solutions to meet these evolving needs. We also explored the challenges and opportunities with respect to digitalization. Increasing progress has been made in technology and is revolutionizing the way we do business, creating new possibilities, but also radical changes. We must seize these opportunities and address the challenges as we build the way for a digital future in our capital markets industry. Finally, it was also important to address and highlight the updates made on the Listing Act proposal and EMIR during our discussions, as these regulatory developments play a decisive role as well in shaping the future of capital markets. You've heard this evening that we have plenty of opportunities, but as we live in a flexible and constantly moving reality, it means we have to faster adapt as well. With all experts listening to the market needs, we have proven already that we are able to turn challenges in competitive advantages, and I'm truly confident that Luxembourg will continue to do so. After all these discussions, I hope you are coming away with some valuable insights, clarity about some of our focused areas, but also a renewed and greater enthusiasm for our industry. And while we share a drink, let us continue to strive for excellence and embrace the opportunities that lie ahead. Thank you all for your attention, and we look forward to seeing you to our future events.